All right, let's kick things off. Today, we're going to take a journey together to really pull back the curtain on the world of securities markets. We're going to break down how stocks are actually bought and sold, figure out how we track if the market is having a good or bad day, and look at the rules that, keep the whole system from going off the rails.
Okay, so here's our game plan. We'll start right where the action happens, the marketplace. Then we'll see how everyone keeps score. After that, we'll talk about how you can actually get in the game, touch on some pretty advanced moves, and wrap it all up with a look at the all-important rulebook. So to get us started, I want you to think about something. When we say the market, what are we even talking about? Where is it? Is it some building on Wall Street? Is it just a bunch of computers in a server farm? What is the stock market?
Well, the truth is, it's not really one single place. It's more like a huge, sprawling network. You can think of it like this bridge, right? It connects people like you and me, investors with money, to companies that need that money to build, grow, and innovate. This connection creates what's called liquidity, which is just a fancy way of saying you can buy or sell your stocks pretty easily, and that makes them way more valuable for everyone.
So let's start with our first stop on this journey. We're diving right into the marketplace itself to check out the big venues where literally billions of dollars in stock change hands every single day.
So when you think of the U.S. market, two huge names pop up: the New York Stock Exchange and the NASDAQ. And they work pretty differently. The NYSE, the one you see in the movies with the big trading floor, operates like an auction. Buyers and sellers trade directly with each other, and a designated market maker is there to make sure everything is fair and orderly. The NASDAQ, though, is all electronic. It's what's called a dealer's market. This means you aren't trading with another investor. You're buying from or selling to a dealer, a financial firm that actually holds an inventory of that stock.
Okay, so you've got millions and millions of trades happening every second. How on earth do we get a simple answer to the question, so how'd the market do today? Well, that's where stock indexes come in. They're basically the scoreboards for the entire market.
Now, one of the simplest ways to build a scoreboard is what's called a price-weighted index. It sounds complicated, but it's not. You literally just add up the stock prices of the companies in your index and find the average. So in our little example here, the average price went from $60 to $61. So, hey, the index is up 1.67%. Seems easy enough, right?
Well, it is simple until a company does something really common, like a stock split. That's when a company, say, doubles its number of shares, which then cuts the price of each share in half. So what do you think that does to our simple little average?
Whoa, look at that! Our miniature company does a 2-for-1 split. The total value of the company hasn't changed one bit, but its share price got chopped in half. All of a sudden, our index crashes down to $43.83. It looks like the market had a catastrophic 27% drop. That's a huge problem, because it's not reflecting reality at all.
So to fix this pretty major flaw, most of the big indexes we use today are value-weighted. Instead of just looking at the price of one share, they look at the company's total value, its market capitalization. You get that by multiplying the share price by the total number of shares. The great thing is this number doesn't get thrown off by stock splits, so it gives a much truer picture of what the market is actually doing.
And this slide just illustrates the difference perfectly. If you were only looking at the price-weighted index on the left, you'd think, hey, great day, the market's up 1.67%. But that's just because the highest price stock went up. The value-weighted index on the right tells the real story. The market is actually down 1.35% because the biggest company, by total value, Goliath, actually lost some ground. See? Two completely different stories from the exact same day.
So this brings us to the three big scoreboards you always hear about on the news. You've got the Dow Jones. It's famous, for sure. But remember, it's a price-weighted index of just 30 companies, so it's more of a snapshot. That's why a lot of the pros really see the S&P 500 as a much better measuring stick for the U.S. market. It's value-weighted and covers 500 of the most influential companies. And then, of course, you have the NASDAQ Composite, also value-weighted, which is fantastic for getting a pulse on the tech sector.
All right, so we know the playing field and we know how to keep score. Now for the big question. How do you actually get in the game and place an order? Well, the answer is you do it through a broker. But before you ever place a trade, you absolutely need to understand something called the bid-ask spread. The bid price is the highest price a buyer is willing to pay right now. That's the price you can sell at. The ask price is the lowest price a seller is willing to take. That's what you have to buy at. And you'll notice the ask is always a little bit higher. That tiny gap between them is the spread, and it's basically a hidden cost of trading.
Let's look at a real example here for Kellogg. The bid is $74.84. The ask is $74.86.
That means if you wanted to buy a share and then immediately sell it, you'd instantly lose 2 cents. That 2-cent difference, that's the spread.
Now, when you go to trade, you've got a whole menu of options. A market order is all about speed. You're saying, get me in or out right now at the best price available. A limit order is all about price control. You're saying, I will only buy or sell at this price or better. Stop orders are fantastic tools for managing your risk, and you can also decide how long you want your order to be active, whether it's just for the day or until you decide to cancel it.
Okay, now that we've got the fundamentals of placing an order, let's look at a couple of more advanced strategies. I have to give you a heads up though, these come with way higher risks, but also, for some, the potential for higher rewards.
First up is trading on margin. This is basically investing with money you borrow from your broker. It gives you way more buying power, which can seriously juice your gains if you're right. But, and this is a big but, it's a double-edged sword. It amplifies your losses just as much. You can absolutely lose more money than you started with, so this is definitely not for beginners.
And then there's short selling. This strategy completely flips investing upside down. Instead of trying to buy low, sell high, you're making a bet that a stock's price is going to fall. You borrow shares, you sell them right away at the current high price, and then you wait. If you're right and the price drops, you buy the shares back cheaper, return them to the lender, and you pocket the difference. It's a high-risk game because if the stock price goes up instead of down, your potential losses are, theoretically, unlimited.
You know, with all this money and risk flying around, you better believe there's a strong rule book and a referee to make sure the game is being played fairly. And that's exactly where securities regulation comes into play.
A lot of the rules we have today were forged in the fire of some pretty big financial crises. The Great Crash of 1920 showed everyone we needed some serious rules. That led to the creation of the SEC, the top cop on the beat, whose main job is to protect investors by making sure companies are being transparent. Then, years later, scandals like Enron led to even more rules to make sure corporations are held accountable. And finally, there's a really important safety net you should know about, called the SIPC. You know how the FDIC protects the cash in your bank account? Well, the SIPC does something similar for the assets in your brokerage account if, for some reason, your brokerage firm goes belly up. But, and this is so important to remember, it does not protect you from market risk. If you make a bad investment and the stock goes to zero, the SIPC can't help you there.
And that brings our investor's journey to a close for today. We've looked at where the trading happens, how we keep score, the nuts and bolts of placing an order, and the rules of the road. Look, the market is an incredibly powerful engine for building wealth, but risk is always part of the game. So, now that you're armed with the basics, the real question is, what's your next move?